Meet Alex, an ordinary person with extraordinary dreams, working hard but living paycheck to paycheck. Always dreaming of more. Travel, a home, freedom from money stress. But every month, the money vanished. Wealth felt like a distant fantasy. One night, Alex stumbled on an article about investing. At first it seemed intimidating, a labyrinth of jargon, but curiosity won. Alex started reading simple blogs and watching videos, and realized investing wasn't just for billionaires, it was a tool available to anyone willing to learn. Even with small amounts, starting small and growing steadily over time. Money could be a tool to build a better future. The biggest risk was doing nothing and letting dreams fade. Alex saw that investing was about basic principles and discipline. Instead of just saving money, you could plant your money and watch it grow. That's when Alex's journey to financial freedom truly began. Let's clear this up once and for all. Investing is fundamentally not gambling. It's crucial to understand the distinction right from the start. Many people confuse the two, but they operate on completely different principles. Gambling is based on pure chance and random outcomes. The odds are inherently stacked against you. You're relying on luck, and the house always has an edge. There's very little control you have over the outcome. Investing, on the other hand, is a carefully considered strategy. It involves research, analysis, and making informed decisions based on available data and market trends. You strategically put money into assets, things like stocks, bonds, or real estate. These are tangible things with real intrinsic value, expecting them to grow in value over time, generating income, or both. The goal is long-term growth and financial security. Imagine helping a friend open a bakery. You believe in their skills and the potential of their business. You invest your money, and in return, she shares a portion of the profits with you. That's a simplified example of investing in action. Gambling, that's essentially handing your money to a complete stranger and hoping for a miracle, with no real basis for that hope. The core idea behind investing is to make your money work diligently for you, generating returns and building wealth. It's about building passive income streams, not just endlessly trading your valuable time for dollars. Investing allows your dollars to earn even more dollars, creating a snowball effect through the power of compounding. Your investments can continue to grow and generate income, even while you sleep soundly at night. It's fundamentally about strategically owning assets that have the potential to generate consistent income, or appreciate significantly in value over the long term. Ultimately, investing is about building substantial wealth that extends far beyond the limitations of your regular paycheck. It's about achieving financial freedom and security. Picture in your mind the image of a patient and diligent farmer, not a frantic and impulsive gambler. The farmer carefully plants seeds, diligently tends to the soil, patiently waits for growth, and trusts in the natural process. Some seasons will inevitably be more bountiful and profitable than others. That's just the nature of things. But with consistent patience, dedicated care, and a long-term perspective, the abundant harvest will eventually come. That's the core mindset and approach of a truly successful investor. It's about making careful and informed choices, exercising patience and discipline, and understanding that you're growing in tandem with the overall economy. Investing is a marathon, a long and enduring game, not a quick and fleeting lucky spin of the roulette wheel. And the best part is, it's accessible to absolutely anyone who is willing to dedicate the time and effort to learn the fundamentals and stick with it through the ups and downs. That's the real and crucial difference between gambling and investing. Why invest? Because inflation quietly erodes your savings. Money in a regular savings account loses value over time. Investing is how you fight back, aiming for returns that outpace inflation. Earn more than inflation, and you're actually building wealth. The real magic? Compound interest. Your returns earn returns snowballing over time. It starts slow, but over decades, the growth is explosive. Starting early is your superpower. Even small amounts can grow huge with time. Someone investing $100 a month in their 20s can outpace someone investing $500 a month in their 40s. Time is the most valuable ingredient. Don't wait. The best time to start was yesterday. The second best is now. Give your money time to work its magic. Start today. When you start investing, you'll see endless options. Focus on the basics: stocks, bonds, and crypto. Think of your portfolio like a team. Stocks are your star players, high potential but sometimes volatile. Bonds are your defenders, steady, reliable, and protective. Crypto is the wild card, exciting, risky, and unpredictable. Each has a role. Stocks drive growth, bonds provide stability, crypto adds excitement and risk. A smart investor builds a balanced team, not just one type of player. Your mix depends on your goals and risk tolerance. Want fast wins, more stocks, prefer steady progress, more bonds, crypto, only if you can handle the swings. The right balance is personal. Find what fits you. Don't chase trends, build a team that works for your future. Start simple, then adjust as you learn. That's how you build a winning portfolio. Stocks. The very word can conjure images of Wall Street titans and complex financial jargon. But the core concept is surprisingly simple. When you buy a share of stock, you're not just buying a piece of paper or seeing numbers on a screen. You actually own a piece of a company. You become a part owner, with a claim to a portion of its assets and future earnings. If the company grows, expands its operations, and increases its profitability, your share's value rises in tandem, meaning you profit from the company's success. It's a direct link between the company's performance and your investment return. Some companies, especially well-established and profitable ones, pay dividends. This is extra cash, a portion of their profits distributed to shareholders just for being an owner. It's like getting a bonus for your investment. So, as an investor, you can potentially make money in two distinct ways: through price increases in the stock itself, as demand for the company's shares grows, and through the regular distribution of dividends, providing a steady stream of income. However, picking individual stocks that will consistently outperform the market is incredibly tough, requiring extensive research and analysis, even for seasoned experts. That's precisely why index funds and ETFs, or exchange-traded funds, are often considered excellent investment vehicles, especially for beginners just starting their investment journey. An index fund is essentially a basket containing shares of many different companies. It's like owning a small slice of the entire market, rather than betting on just one or two individual companies. For example, a fund that tracks the S&P 500 index automatically gives you a piece of ownership in the 500 largest and most successful publicly traded companies in the US. This approach is called diversification, and it's based on the principle that you shouldn't put all your eggs in one basket. Because if one company within the index fund experiences difficulties or even fails, the performance of the other companies in the fund can help to balance it out, mitigating your overall risk. Therefore, for most people who are looking to build long-term wealth, buying and holding a low-cost, broadly diversified index fund is often the smartest and simplest way to invest, allowing you to participate in the growth of the overall market. It's a proven strategy that has historically delivered solid returns over the long term, making it an ideal approach for retirement planning and other long-term financial goals. Bonds are the calm, steady part of your portfolio. When you buy a bond, you're lending money to a company or government. In return, you get regular interest payments and your money back at maturity. Bonds are safer than stocks. If a company fails, bondholders get paid before stockholders. Government bonds, like U.S. Treasuries, are among the safest investments. Corporate bonds pay more interest but carry more risk. Bonds provide stability and income, smoothing out the ups and downs of stocks. As you get closer to retirement, you'll want more bonds to protect your savings. The right mix of stocks and bonds depends on your age and goals. Balance is key. Bonds help you sleep at night. That's why they belong in every smart portfolio. Cryptocurrency, like Bitcoin and Ethereum, is digital money built on blockchain technology. It's decentralized, not controlled by any government or bank. Crypto is high risk, high reward. Prices can swing wildly in a single day. Some early investors made fortunes, but many lost everything. The technology is new, the market is unregulated, and scams are common. There's no safety net. If your crypto exchange fails, your money could vanish. Treat crypto as a speculative bet, not a core investment. Only invest what you can afford to lose, maybe 1 to 5% of your portfolio. Do your own research. Don't follow hype or social media tips. Approach with caution and skepticism. Crypto is exciting, but it's the Wild West. Be careful. Never risk your future on a gamble. Ready to start? It's easier than ever. Open a brokerage account online. Fidelity, Vanguard, Schwab, and others are great options. Fund your account. Start small. Even $50 or $100 is enough. Set up automatic transfers to build the habit. Use dollar-cost averaging. Invest a set amount regularly, no matter what the market's doing. For most beginners, buy a low-cost index fund or ETF, like one tracking the S&P 500. Search for the fund's ticker symbol, enter your amount, and click buy. Congratulations, you're now an investor. The hardest part? Patience. Don't obsess over daily ups and downs. Investing is a long-term game. Think years, not days. Stick to your plan, keep learning, and let compounding work for you. It's not complicated, just requires discipline. Your future self will thank you. Start now and keep going. The real secret to investing isn't picking the perfect stock or timing the market. It's time, patience, and a commitment to keep learning. Time lets compounding work its magic. Start as early as you can, even with small amounts. Patience keeps you steady through market ups and downs. Don't panic when markets drop, and don't chase bubbles when everyone's greedy. Boring is good. Stick to your plan and let it work. Never stop learning. Finance evolves. New tech, new products, new risks. You don't need to be an expert, but stay curious. Read, listen, and learn from trusted sources. Education builds confidence and helps you ignore the noise. Your financial journey is ongoing. Embrace it. Be patient, keep learning, and give yourself time. You'll be amazed at what you can achieve.